All right. Thank you, everyone, for coming. Good morning. It's good to virtually see quite a few people coming on the call so far. This is our July 2020 monthly webinar, trying to keep Infometrics clients in the loop with what we're thinking and what's going around in the economy. I'm joined today by Gareth Kiernan, our chief forecaster, and his furry friend behind him, as well as Economist Andrew Beattie, which makes up a good part of our forecasting team. Of course, this month's been a big month for us in terms of putting out our latest quarterly forecast, which is why we've got the team here. But of course, we are very much back into this wait and see period with the economy seemingly in a pretty good position. We've seen over the last few weeks spending numbers coming through, which do certainly provide a bit more optimism throughout New Zealand. I guess what we're seeing at the moment is relative to level 4, everything feels pretty good. Relative to normal times pre-pandemic, things are still not quite operating at the same level. But again, I think we continue to see these changes in the economy that do demonstrate that New Zealand is doing a lot better than we might have previously expected, and certainly better than the rest of the world. Just before I throw over to Gareth and Andrew, I just wanted to highlight some of the changes we've seen across the economy in recent weeks and months since we last talked to you about a month ago. Essentially, again, the globe continues to proceed along an even more uncertain and horrendous path. We're seeing increased numbers of COVID-19 across the world, and increasingly we've seen those a little bit closer to home as well, with rises in Victoria. I haven't seen today's numbers, but I know that yesterday's topped 500. It does very much dash any hopes for a trans-Tasman bubble for the next wee while. Across the economy, we've had some numbers coming in recently that does demonstrate that spending activity is getting better. Again, overall, though, there's still around about $2.5 billion of money that been spent that would normally have been, and so again there's very tough conditions out there for a number of people. Since the 20th of March, so just prior to lockdown, there have been just under 66,000 additional Kiwis who have gone on to the job seeker support or the COVID income relief payment. That's more in 4 months than the entire GFC hit to employed people, which was 65,000 over 21 months. Also worth remembering that is 66,000 Kiwis who've lost their jobs, even when the government has supported 1.71 million jobs at a cost of $13 billion. And as Gareth will demonstrate shortly, we remain concerned that once that support is removed from the economy, things will weaken considerably. The other, I guess, important numbers to highlight is that so far we've got over 450,000 people supported by the wage subsidy extension. Again, those are companies that are suffering a 40% decline in revenue. And it's also quite critical to highlight that in the past 5 weeks, there's been about 60,000 odd people that have been supported by the wage subsidy or extension for the first time. So they haven't requested support, they're now having to go to the government for additional help. It does highlight again that things, although they do appear better for many in the economy, are still pretty hard for a number of businesses out there. So with that, I'm going to turn over to Gareth. Now, like I said, we've been doing our forecasts, and we released our latest national forecast last Friday. And we thought this time around we'd get Gareth to go through some of our expectations for how our judgment has shifted around the economic outlook and what are some of the key things to watch. So Gareth, I'll hand over to you.
Great. Thanks, Brad. I'll just share my screen, and hopefully you can all see the presentation coming through there. Yeah, so Brad's touched on some of the things I'm going to talk about. It's a fairly brief presentation in many respects, but also try and get through things fairly quickly. So let's just kick off looking at some of the indicators that I guess it's a case of, we feel quite happy about how things are in New Zealand and how they're panning out, but there is a disconnect between that sort of general sentiment of the sort of average guy on the street and how we actually expect the economy to go. I'm having issues here in getting the slide to go along, but there we go. And I want to take you through three aspects. Firstly, the job losses, and Brad has touched on some of those, and also look at spending activity, how that's been panning out, as well as the international COVID numbers, just to put them in perspective for you. So this looks at the weekly job loss numbers over the last 3 to 4 months. And you can see initially when lockdown hit, you'll probably be familiar with these figures, quite a big spike in job loss numbers, which tapered off over subsequent weeks. And then as the wage subsidy started to roll off, while sort of economically or in terms of freedom of movement, life was starting to return to something like normal, there was another round of people losing their jobs. However, what we've seen since the start of July is that those weekly job losses have started to fade away, and certainly not getting the same tsunami really of job losses that we might have been anticipating probably 2 months ago. And largely the reason for that is the extension, in our view, the extension to the wage subsidy scheme. And Brad touched on the numbers of people who are, or the number of jobs that are still being protected by that. We'll come to that a little bit later on in terms of what we think it's going to do to employment going on from here. But just to summarise those figures, you can see over 66,000 job losses occurring over the last 4 months. And as Brad said, that's more than we saw in almost 2 years following the global financial crisis. Possibly still a lot more to come yet, but at the moment, because those job loss numbers have been relatively subdued, particularly over the last couple of months, people for now are feeling a little bit happier about how things are going. If we have a look at spending activity, this is weekly spending. This is comparing levels of spend to how they were a year ago. And this data comes from MB. They've sourced it, I think, from Paymark. And the graph you see is the total spend by, in terms of retail spending or electronic card spending within New Zealand. So you can see very clearly, obviously, the effects of the lockdown. But what I want you to concentrate on is what those numbers have looked like post-lockdown. If you look basically since mid-May, the growth in the value of spending, and let's be clear, it is the value of spending, is up around 2 to 3%, sometimes popping up towards 5% from where it was this time last year. If you think about those figures, you can obviously see a very big hole in spending through April and May, excuse me, which hasn't been made up for. There's been a bit of a talk about a post-lockdown spike in spending, but if we're entirely honest, it's very difficult to see it in those aggregate numbers. However, since lockdown ended, there have been some store types which have performed okay, well, better than okay. They've done quite well in terms of spending growth, leading the way home and recreational retailing, up almost a quarter from where it was this time last year over that 7 to 8 week period since lockdown ended. However, if we look at the numbers since the start of lockdown, aggregate spending for that store type, for example, is still down 14% over the 4-month period since lockdown began. So there has been a bit of a catch-up going on for that store type, but still behind where it was a year ago once you take the lockdown into account. I've shown you some of the more positive ones there, but in terms of the ones that are really struggling, over the last 4 months, we've still had transport and travel agencies. Their total spend is down 85%, arts and recreation down 63%, accommodation down 54% as well. So it's a really, really big hole in terms of some of those spending categories. And you look at the individual categories, not really the sort of post-lockdown catch-up in general that we might have otherwise, or that some people have talked about in terms of those numbers. Those are a couple of domestic indicators for you. If we look internationally, of course, it's easy to forget that while COVID is virtually non-existent here, apart from the odd person returning from overseas, things are still getting worse around the rest of the world. So this graph here shows you daily COVID numbers, the number of new cases coming through, and you've still got that exponential growth coming through, up and down from day to day. But generally speaking, those numbers are still getting worse. And so you think about what's going on internationally, the fact that some of those countries throughout Europe, for example, are easing back on their lockdown conditions. Almost seems to us like people are sick of lockdown, and while we might have got on top of COVID a little bit in many of those countries, it's sort of you open the economy back up and you start pushing yourself back towards square one. So there's real issues there in terms of how those economies perform over the medium term. In terms of New Zealand as well, of course, worth bearing in mind for something like international education, with no signs the border is going to be open anytime soon. Estimates are that that's worth $5 billion to New Zealand's economy. You're talking roughly 1.5–2% of our economy. The government yesterday, today's Tuesday, isn't it? The government yesterday announced they were going to provide some money for international education, 51 million, roughly 1% of the worth of its value to the economy, to try and support it. Drop in the bucket, really, in our view. And there's no clear strategy from the government in terms of getting the borders open, not in a wholesale sense, of course we wouldn't want that, but even in terms of enabling people to come from overseas and go through some sort of managed isolation or quarantine process, outside of course the very limited numbers that we're having come back in terms of New Zealand citizens back into the country. So there's a few things which are going on there. What does it mean in terms of the outlook? So I've shown you the global COVID case numbers. What does it look like in terms of economic growth internationally? And this shows you expectations prior to COVID back in January, expectations in April, roughly this time we released our last set of forecasts, and then the latest numbers we've got, which for June, we do have some indication of the July numbers, but not for all the countries there, which is why I haven't graphed it. But you can see that certainly over the last two to 3 months, they have continued to deteriorate, particularly when you look at those developed economies through United States, Western Europe. If you looked at Latin America and Africa as well, as COVID has started to spread more profusely through those parts of the world as well, that has really hit economic activity. Interestingly, when you look at the growth numbers, expectations for economic growth in 2021, not entirely making up for the ground that is expected to be lost in 2020, but often with the downward revisions we've seen this year, a lot of people at this stage still expecting things to bounce back almost towards normal and making up for that lost ground in 2021. And we're pretty dubious about whether that's going to occur, particularly given the evidence we've seen from the likes of Australia and parts of Europe, where countries have been, or parts of countries have been forced to, pull back on the sort of freedoms that they've given people over the last couple of months, but as COVID has reasserted its presence within the community as well. Given that global outlook, what's our thinking around New Zealand's GDP? And I would have shown you a similar graph when we presented our previous set of forecasts to this one here. And I'm comparing what we were showing you in April with what we're expecting now. And a couple of points to note. Firstly, we've revised down economic activity in the near term. That's simply a refinement of our estimates of how big the effects of the lockdown were on the economy. It's not that things have gone worse than expected, it's just that we've sort of said, well, the lockdown actually looks like it might have had a greater impact than we were initially expecting. Probably what's the key though in terms of New Zealand's performance, firstly, this period through 2021 and into the first half of 2022, where we do expect economic activity to be higher or greater than we were previously anticipating. That does reflect the fact that life within New Zealand, notwithstanding the closed borders, has returned to something much closer to normal. And so economic activity is able to bounce back a bit more quickly. We've also had more government support coming through, and I'll show you the effect on that in terms of the labour market in a couple of slides' time. The other point to note, though, is over the medium term, we have revised down our expectations of how quickly the New Zealand economy is able to make up the ground that's been lost in COVID. So basically, your growth from 2023 onwards is slower than we were previously thinking. And that reflects primarily what's going on in the international economy. That's one of the factors there. And so we're concerned that there are going to be long-lasting effects from the pandemic which limit global growth and therefore which feed through into weaker New Zealand growth as well. The other factor that we're concerned about is household spending. Before I get to the outlook for household spending, let's just have a quick look at a couple of indicators for you. I've touched on what we sort of are thinking around the job market, but let's see what it actually means for employment. So you can see, comparing our previous forecasts from April with our current numbers on this graph here, basically we don't have it falling away as quickly. or as sharply in the near term, and that does reflect the amount of government support that has been put in to protecting jobs through the wage subsidy, and probably more particularly through the wage subsidy extension as well. The trough in employment, not quite as bad. So we have seen the effects of government policy, partly the effects of the return towards more normal economic conditions, mitigating the extent of the total job losses that we're expecting as well. So a slower downturn, but still coming quite significantly, not quite as bad as we were previously predicting. Nevertheless, that is still a very big hole in employment. To give you a feel for what it means for unemployment, we're still expecting the unemployment rate to hit 8% at the end of this year and push up to over 9.5% in the second half of next year. Our current estimates, and we'll get numbers on this next week, are that the unemployment rate's probably sitting a little bit below 6% in the June quarter. So there's certainly still substantial rises to come. Bearing that employment outlook in mind, what do we think is going to happen to household spending? Now, I'm not going to show you a graph of our forecasts of household spending, but have a look at the positives and the negatives on this slide. I'm not going to go through each of them in turn, but probably the key point to note is for the positives there, they are relatively temporary measures in terms of government support. That's all we can really identify on the positive side, whereas on the negative side, there's a whole lot of stuff in terms of where that labour market potentially goes, whether it's consumer confidence, employment confidence. We've even got actual earnings data for May, which was down 12% as people's incomes were cut, either because they weren't working, of course, or because there were temporary pay cuts coming through as well. So all those factors you see on the right-hand side, we think fundamentally they're a more important influence on household spending. So if you went back to that graph of GDP growth, or the levels of GDP that I showed you previously, alongside the effect of the global economy and the potential sort of dampening effect it has on our export growth, we're also expecting a weaker medium-term outlook for household spending. More volatile in the near term, and over the medium term, we think there's lingering effects that will be felt in terms of households' willingness to spend. I'm going to turn over or pass over to Andrew. He's going to give you a few slides just focusing on or talking about that international outlook and what it's doing to trade, as well as what's happening in the transport sector.
Yeah, thanks, Gareth. So as you said, I'll just be a brief intermission before I pass it back to Gareth to take us through to the end. But just a brief discussion on the trade, particularly around that goods side. So taking out that services part, particularly around tourism, which is obviously not in a good state. And then I'll segue onto a bit of our transport forecast afterwards. So last week, the provisional data came through for merchandise trade from Stats, and that had goods exports down 2.6% for the June quarter, while imports were down a whopping 17% for the June quarter. And if you look at our goods exports, 2.6% decline, considering through pretty much all of April and a bit of May, we're having a bit of restrictions on how effective we can be with our trade. A 2.6% decline is not actually too bad. And you can see that through this graph here, if you look at the red line there. So this is comparing value of goods exports for the 3 weeks compared to the same 3 weeks last year. So through that lockdown time, there was a bit of a decline, and it's since come back to, I think we're now sitting around the 5-10% growth in exports, which is actually not too bad considering. And what's largely driving that is dairy trade has actually done quite well throughout the lockdown even, and through up until now. And largely that's going to China as well. I think most recently dairy exports to China were actually up 40%, which is quite staggering. Brad was telling me this morning actually that apparently there was a message in the Shanghai press or something like that saying to drink milk to help your immunity or something, but It's those, that dairy really is holding up, as well as other sort of food exports as well. Meat sort of held quite constant throughout the lockdown and after. There's been, throughout the lockdown, there was sort of issues with processing at the abattoir as far as keeping processes close enough together. So there was a bit of slowdown there. Seafood, however, has sort of slumped away, probably largely due to that high-end restaurant trade declining. But really, it's the non-food exports which have crashed, and that's particularly in forestry as well. As you can see on that light bluey turquoise line, forestry was already actually in a bad state before, and that was largely because of low prices. But then China, who's also our major, where we export most of our logs to, obviously went into lockdown earlier. And so you saw that decline in forestry exports quite quickly, but has since then obviously recovered as well. And that's partly why we're seeing a massive sort of recovery in those forestry volumes. And the same is with other non-food goods exports as well. That was where we saw most of that crash too. On the import side, however, that has been a massive crash, particularly around sort of the general transport sector. It was the imports of vehicles and parts were down, and cars and both new and used cars fell $189 million in the month of June, while trucks and vans fell $67 million in the month of June. Other imports that were down was machinery and equipment, as well as petroleum as well. The only other transport sector that was actually up was spending on ships and boats, where we bought a $500 million naval vessel from South Korea. And so that actually made imports in the month of June very slightly positive, but that aside, imports in general have been quite far down. And so, Gareth, are you in control of these slides here? Yeah, thank you. And so here, looking in how this has been affecting the supply and demand for vehicles, this is essentially what's going on is you've got the monthly imports minus the registration. So when you've got the bars above the zero, that essentially means for that month there was an oversupply of vehicles. And throughout sort of a long time period, that's going to average to zero. And what you can see in those first two large spikes in March and April, what happened there was imports of vehicles were actually staying constant while those registrations crashed down. There were the ability of those shifts of goods across the oceans wasn't quite able to keep up with the shift in quick demand from lockdown in New Zealand. And then since lockdown has been uplifted and registrations have started to pick up, particularly for used vehicles, slightly for new as well, still quite down in general. The imports are actually still massively down. So as you can see, there's been almost 12,000 vehicles less imported compared to the number that were registered in that time. And you can see in the yellow graph there, it's mainly those used vehicle registrations where that massive fall has come from. And that is possibly partly to do because the market saturation for imports of vehicles is coming largely from Japan as well. And so there's potential issues with bottlenecks of supply issues there. And going forward, those two numbers seem to be about equaling out right now. But if there's potential supply issues going forward, that might have implications on the price of vehicles as well as just the availability in general. But looking forward next to our forecasts of registrations, you can see that in the June quarter, here, registrations have crashed quite significantly. For new vehicle registrations, it crashed 42%, and that's not quite as bad as our 47% decline we forecast back in April. and used vehicles was a 35% crash, not quite as bad as I think a similar 40% decline as we thought back in April. And that's the change in our view there for the looking out in the forecast is that partly that we came out of these lockdown restrictions sooner than anticipated, and the domestic economy has got back up and running quicker than we might have thought back in April. But we still see them crashing away up until about March, or dropping away up until about March 2021, and then sort of recovering there on in. For new vehicle registrations, the revision upwards hasn't been quite as much. We still see that tourism effect playing quite an important role in that new car market, as well as sort of small commercials as well, the vans and your camper vans and such. Because it's that last 6 months of the year where the tourism registrations are usually the highest. There was about 14,000 rental cars registered in 2019 for the final 6 months of the year. So we really see, with those crashing away, that still to be a lot of downward pressure on the registrations. As far as the used car registrations, we've revised them up slightly better because of a substitution effect we're seeing of people moving away from potential buying a first new import and potentially buying a used car for first time registrations. But another interesting part of the car data is that the change of ownership has actually spiked, particularly in for the June month. Obviously down during lockdown, but in the June month, changes of ownership was actually up 27%. So that's potentially showing that more people are buying cars online, possibly through Facebook Marketplace or Trade Me and such. And the crash away in registrations for commercial vehicles as well is much the same. Slight revision upwards in our forecasts, and that sort of demonstrates those same upwards revisions we're seeing as well. Whereas the crash in the labour market is not quite as bad as we initially thought, as well as not quite as sudden. But also with those the commercials as well, with those exports, those goods exports holding up quite nicely. There's been some upwards revisions there. Yeah, and that's the end of my intermission. So back to you, Gareth.
Great, thanks, Andrew. I'm just going to take you quickly through not all the influences on construction and on our construction forecast, but just picking up on some of the key points. And the two I want to show you, migration and house prices, also, of course, relevant for some of the broader economic outcomes as well. So let's have a look at migration firstly. And this has been an area where we have quite significantly revised our forecasts. 3 lines on this graph. You've got our previous set of forecasts from April. You've got our current thinking, and then you've also got the yellow dots, which show you Stats NZ's current estimates of where they think net migration has gone in terms of their modelling. Now, those of you who've listened to us talk about Stats migration estimates previously will know that we're not great fans of them over the last 6 to 8 months. They do tend to be quite volatile. That's at the best of times. And of course, we've had very unusual economic circumstances over the last few months, which means that their modelling is probably, the way their model works, the machine learning behind it, is probably going to be even less accurate than it would normally be, because it works based on, well, what's the sort of normal historical trends that it sees in people's behaviour, and therefore what does it mean for current movements. So Stats NZ, you can see their estimates showing that net migration has spiked up to what would be a record high of 85,000 if we believe those figures. We do think, of course, with more New Zealanders returning home, that net migration will have lifted. If you asked us 3 or 4 months ago about migration, we would have said, well, you know, prior to lockdown in the early stages there, we were expecting a bit of a rush of New Zealanders coming home, but beyond that, we're expecting, you know, net flows to push down to 0 over the coming year, because there was nobody coming and there was nobody leaving. Well, it turns out there's actually more New Zealanders coming back and on an ongoing basis than we would have anticipated. Although, of course, the government has put limitations on those numbers because of the quarantine facilities and the capacity within those. Nevertheless, when you look at those numbers over the next 18 months or so, it is a significant upward revision in the migration figures, which has implications, positive implications for the overall economy in aggregate terms, but also obviously on demand for something like housing, also on demand for vehicles, and that will have been a factor that Andrew will have taken into account in his vehicle forecasts as well. The other point I want to make in terms of the influences on construction as well, house prices. And you can see here, again, comparing our latest house price forecasts with what we were predicting previously. Now, those of you who read the headlines will have seen real estate agents going on about how the housing market is still going strongly. House prices are still up, and they have, to be fair, they have held up better than we would have anticipated. But mostly, we were saying wait until the mortgage subsidy scheme ends in September before you start, getting too excited about how robust the housing market might be. And we're still holding to that view. Look, we have mitigated the extent of the house price falls. We were expecting a total fall of around about 11% by the end of next year. Now we're talking about a total fall of around about 6% in those property prices. So it is a more positive story for the housing market. That does reflect some of the economic outcomes we've talked about, does reflect the stronger population growth and net migration as well, which will have flow-on effects in terms of underlying demand for housing. So the house price outlook, it's still weak, but not as weak as we were previously thinking as well. So let's turn finally to construction activity and just look at where we expect that to go across the three construction types. We'll start with residential, and you can see we have again revised up our numbers there. And there's a few factors behind our consideration. One is the net migration picture that I've shown you. Just to give you a feel for the numbers around the net migration, basically that faster population growth that you saw in the previous slide contributes to a significant lift. And if you look at our consent numbers through the next 5 years, it doesn't really show up that much on the graph, but over a 5-year period through to 2025, we actually have lifted those consent numbers by a total of almost 25,000. So averaging around about 5,000 more a year over the next 5 years. It's still a big drop off from where we are in terms of current numbers, but a substantial upward revision. Alongside the net migration feeding into that forecast is the government's announcement at the budget in May that they were going to build another 8,000 state houses over the next 4 to 5 years. So that, again, that contributes to activity as well. And we'd expect that promise or that policy to be more successful in terms of its implementation than Kiwi build. So just to be clear, we have incorporated that into the numbers, whereas we were always very sceptical about whether Kiwi build would actually come to fruition in terms of its the promises that were made there. The other point I want to touch on this slide is some of the feedback, or a lot of the feedback we've been getting from talking to people through the construction industry around the country over the last couple of months, is that everybody's still happy about the or almost everybody is still happy about the pipeline of work that they've got on, catching up for lost time with lockdown, for completing the jobs that were there. And talk to most people, they say, yeah, we're good through to the end of the year, which would probably be pretty normal at this time of year, that you've got another 4 or 5 months of work ahead of you. The big question for us is, well, what about 2021? And you may have seen over the weekend that the Master Builders had done a survey of some of their members, residentially focused, I believe, the survey, and they said that, just have a look at the numbers, 2/3 of their members had seen their order book shrinking by 10% or more since lockdown, and 1/3 of their members had seen their order book shrinking by 30%. So while we haven't yet seen it in terms of the actual levels of activity and in terms of what is still happening over the next 6 months, beyond that, we are quite concerned about what 2021 may hold for the industry, and that survey would tend to back up our view that there are substantial drops coming through, tied up obviously in terms of what's happening with the labour market and the overall size of the economy. Worth reiterating as well that construction is very much a confidence-driven beast, and so where there is no confidence, that is going to significantly impact on the levels of activity that may occur. In the non-residential space, We have revised up the numbers in the near term. Basically, the effects of the lockdown on construction activity, not as great as we might have expected. Councils continued processing consents and indeed return to relatively normal levels of activity. Back to, alert level 1 has meant that near-term drop-off is not as great as we'd previously anticipated in terms of completed work. But again, over the medium term, you can see we have just pulled those numbers down a bit from where they were 2022 through to 2025. Up on the right-hand side, you can see the extent of the declines from the pre-lockdown peak in 2019 through to the trough in activity that we're forecasting in early 2023. Picked out some of the more negative building types there. And the ones I've highlighted in purple, even though we've got a 40% drop in accommodation construction forecast, the risks would still be on the downside for that one. It's very hard to make a business case for building any hotels at the moment unless you think you're going to be quarantining people for some long period of time in the future. So accommodation building, still risks there. And again, in terms of office and shop building, you can obviously read more of the detail around the forecasts on our website, but still concerns there about just how much the oversupply of space might be going forward, given the job losses, given possibly not as much need for office space, depending on how much we continue to work from home. We've been pretty conservative on that, really, to be honest. We don't expect a whole-scale shift in terms of people's behaviour. There'll be a bit at the margins. And, of course, retail spending, with the massive pressure that the retail sector firstly has been under through lockdown, and then, of course, with job losses likely to continue coming through, we're going to see vacancy rates rising there. Final area of construction I want to quickly look at for you is around infrastructure. And again, just comparing our current forecast with what we were thinking back in April. And not quite as big in terms of that lockdown effect in the near term, but really the big shift here in this forecast is the fact that we have moderated that expected growth in infrastructure activity over the medium term. We don't have all the details yet, but having looked at large parts of the shovel-ready projects that the government has announced, we're a little more confident than we were previously that will actually start to generate more growth in activity through 2021. It'll take a little time to come through, but we are expecting them to be fairly quick to get going in comparative terms. But the issue for us was that $3 billion, I think it was $2.6 billion that was allocated when it was announced a couple of weeks ago. It's pretty underwhelming in terms of the volume of work that actually implies. And we had been expecting a much more substantial infrastructure stimulus package potentially to be announced by the government. A reminder as well that the upgrade program that the government announced back in January, it seems like a lifetime ago, with several major projects in there, while that was also touted as shovel-ready, work there is not expected to peak until 2024. So that feeds through into some of the growth you see out later in the forecast period. The other point I'd make around infrastructure as well is that with the announcement that TY Point is going to close next year, there were a number of electricity generation projects which were starting to get closer to going ahead, and some of them are going ahead in a couple of wind farms. But in terms of the other ones that aren't underway, it's now very unlikely that those will progress in the foreseeable future when you've got somewhere between 10 and 15% of the country's generation capacity, which is suddenly going to become available over time. There'll be a bit of investment needed from Transpower to upgrade the national grid and the Cook Strait cable, but that does mean that over the medium term, you don't have any real need to go investing in new generation capacity when that's coming through. I have put a question mark at the end of that point, though, because you may have seen over the weekend the government talking about projects where it could pump water in hydro dams back up to the top of the dam in times of low demand. It's almost like a battery. They use the word battery in inverted commas. And those projects, there's one certainly touted in Otago. I really don't see the logic for going ahead with it. But if they do, well, apart from potentially environmental, for an environmental reason, but if they go ahead with that, that was being touted as somewhere around about $4 to $5 billion worth of work. So watch this space in the electricity area. So to wrap up for you, I guess, look, the key for us in terms of these latest set of forecasts is life feels normal in many respects, particularly if you're not directly involved in terms of business and seeing a hit to your revenue or demand in those spaces. But the issue is when you look at the global situation, when you look at how businesses are feeling and the sort of hit to revenue that has occurred for many of them and the squeeze that is continuing on, there is a massive disconnect there. So don't get fooled by the sort of normality of day-to-day life and the fact that things so far may not have turned out too badly, not as badly as we might have been fearing 3 months ago, because there is still a lot more water to go under the bridge there, particularly when we look at those elements of government support around the wage subsidy and its extension, the mortgage holiday scheme as well, and the fact which the government announced a couple of weeks ago that they were going to be keeping $14 billion of their $62 billion fund in reserve in case there was another outbreak of COVID and they needed to support the economy. Now, I have no issues with that, but the fact that the government has basically come out and said there's not much more money, not much more spending we're going to do, we're cutting off the wage subsidy, and there's not much more in the pipeline. It says to us, actually, well, the economy has got to start standing on its own 2 feet. And the issue there is you've still got the border closures. So you've still got tourism businesses, international education, which are, where do we go to from here? And certainly there's no clear plan to us at the moment particularly around those borders and how that situation changes. Yet when you look internationally, obviously, there's no way that we can reopen the borders in any wholesale fashion either. So, we'd be very, very keen for a much firmer plan in that space. Until that occurs, in terms of New Zealand's potential for economic growth, there is going to be difficult conditions to work through. As I've said at the bottom there, stay informed. I mean, thanks for tuning into the webinar. It's part of the process, obviously. It's also about, from a business point of view, trying to stay agile or nimble and adapt as conditions change on you, pivoting, because if you're in the tourism space, obviously it's being able to change what you're doing quite fundamentally or radically in many cases to make sure that you can survive. And the final point is I'm not a great protectionist in terms of, sort of classic or orthodox economist and supporting trade, but at the moment, if you can support local, then there's potential that you are also supporting jobs and businesses around you as well. So it does have a role to play in these unusual economic times. So happy to take questions now. And Brad, I'll stop sharing my screen, but you got any questions out there today?
Haven't got any questions yet, but please, everyone on the call, if you have any, put them through into the Q&A and I will start to ask the team. I think, though, Gareth, at that point right at the end is I think the key one there is that the economy has got back towards a better level of economic activity much faster than we might have anticipated, and that's great. But I think what we're seeing at the moment, and correct me if I'm wrong, is that we've got the economy operating below what it normally would, and that path back towards 100%, if you will, is still very, very difficult. If you will, if you think about us operating at 90%, trying to get through to that last 10% when you have the globe in such a hard economic space, when you don't have international education, a $5 billion export market, when you don't have international tourism, a $17 billion export market, it's very hard to see what that pathway further up is. And I think that's probably our key definer, isn't it, for those forecasts, that the drivers of further activity are still so far away.
Yeah, they do. I mean, that is a function, or shows through in that graph, or persistent GDP graph, where it's persistently below the pre-COVID forecast that we had. And you're right, it is at the moment, it actually looks to us increasingly hard to close that gap, given the pathway forward is very, very unclear for some of those large key sectors.
Great. Okay, we've got some questions starting to roll through, and we'll go with them. And Beattie, we might bring you in here as well, given your recent travels to the South Island and seeing what intelligence you managed to gather on the slopes. We've got a question here around domestic tourism and how much is that going to offset this decline in international tourism activity? I mean, Beattie, you were on the slopes. It was seemingly pretty good down there for part of the ski season, at least.
Yeah, I was down in Mount Lyford, and there were quite a few people around. But what I sort of noticed down there was that was also during school holidays as well. So it's probably being slightly well, probably even more so distorted, because a lot of those people during this time might have escaped the winter to go to the Pacific Islands or Australia or something like that. So there was a massive influx of tourism, particularly I bet a lot of Aucklanders up on the mountain. So I think there definitely is a lot of scope for definitely a bigger pickup in domestic tourism. But still, if you compare the amount of tourists going over internationally compared to the domestic tourists going over internationally compared to the number of international tourists coming in, there's a massive discrepancy. So it's not quite enough to outweigh, although you can definitely see there is a lot of support local going on, which is nice to see.
Yeah, no, that's definitely fair. I mean, Gareth, you also did some travels. What's your assessment, both in terms of what we've seen recently and also, I guess, that ability for it to endure and to make up the hole that's been left by international tourism?
Yeah, so I was in Queenstown for the school holidays. That was booked well before COVID, actually, and so many Aucklanders there, more Aucklanders cheering the Blues in the pub than there was cheering the other team, which was very odd. But yeah, I think, look, one of the points, I back up what Andrew is saying in terms of it's not necessarily sustained at other times, I think, and for tourist operators, that's almost more of an issue. You have to have full capacity through the school holidays because everyone's there, and then a week later when they've finished, you're running at, I don't know, I'm not going to make up a number, but you're certainly running well below capacity, and so you'd almost prefer the sort of smoother outlook for activity than these huge peaks and troughs. Yeah, so I think, look, we haven't completed any more sort of regional modelling around it, but my expectation would be that in terms of the hit for, say, somewhere like Queenstown, economically, it probably won't be quite as large as we were thinking, but still, down the more significant end in terms of those negatives. Other areas, say, like Mackenzie, or I read a story on Fiordland, I think yesterday. Basically, those areas where they're maybe not quite so well connected, you're not getting the international tourists, but you're also not getting many domestic ones, could still be under a lot of pressure. So, yeah, it helps. The domestic side helps a bit, but it's certainly not a full saviour, that's for sure.
And I found it interesting going to Auckland for a few days, and it was certainly quieter in Auckland than I might have expected. And that was during school holidays. People were obviously moving out of there, but it was quieter than I might have expected, given how well activity seemed to be doing. But I think you're right as well, Gareth, that those hits look like they're possibly not as bad as when we were in the depths of lockdown trying to figure out what was coming through, but it's not like they're a good result either, which I think is important. Okay, a few more, and we've got quite a few coming through for construction, so I'm going to try and bundle them all together. I mean, and Gareth, obviously you did sort of note some of these around the construction outlook. I mean, what sort of investments are people going to be looking for in that sort of construction area? Because, of course, it's not all going to go to zero tomorrow. And so that's sort of the first question is what are we likely to see that investment profile look like? And I guess I say that in the context that the latest numbers from the Reserve Bank did note that borrowing for commercial property is going to become incredibly difficult to access. And I guess what does that mean when it comes to thinking about development across the country?
Yeah, I mean, that is one of the concerns we'd have, and both the Reserve Bank, it was the Reserve Bank where they had surveyed it, and the message coming through was that the banks were actually writing down the value of the properties behind the lending they'd done in that commercial portfolio space, basically just not really sure, knowing what the property values or the yields were going to be doing. And so that meant that the banks were also had less money to go and lend to any other sort of new developments or new construction. So it's a bit of an interesting dichotomy there, because I have also heard, messages that because New Zealand has come out of this relatively well, we could be quite nicely placed to attract international investment into commercial or industrial property. But I think it's probably a little bit early to have expectations around that. I suspect that is a case of wanting just to see where the dust settles, particularly, and so in the near term, it is what happens to vacancy rates and rents and potentially property values, and bearing in mind as well in that commercial property space, we already had expectations prior to COVID that there were signs of an oversupply, particularly in the likes of Auckland. starting to occur for office building and retail building, and so had been thinking that that was going to dip away as well. In terms of the housing market from an investor point of view, yeah, I think we've seen, again, the numbers from the Reserve Bank suggest that the investors have pulled out there at the moment, and not particularly keen. They're worried about price falls. So not that they're necessarily selling their property, but there's certainly not that buyer demand at the moment as well. And so you're seeing a bit more first-time buyers making up a bit more of the market there at this stage. I note the question also says, talking about, well, sort of hints at what may be going on in terms of financial markets, but gee, the share market's still holding up remarkably well given the sort of global chaos that we've got. Who knows what that means about where it'll be tomorrow or in 6 months' time. But it certainly doesn't seem to have put people off, and it's possibly a reflection of the fact that money is relatively cheap at the moment and still looking to find a home, which has implications as well as for how far property values may fall if there's still weight of money coming in that could limit those price falls.
So okay, so that's residential and non-res. That infrastructure space, just to pick up on what we discussed around these shovel-ready projects, which, as we all know, shovel-ready is an interesting term, shall we say. I mean, why are we thinking differently about those than the government's previous ability to deliver on projects? What's the difference there in your mind?
Yeah, one of the differences there is that it's the size of the projects. There, it's a lot of smaller projects the government has tried to bring together in that $3 billion fund, versus the upgrade program, which was 9 projects off the top of my head, totaling around about $7 billion, and obviously it takes a lot more planning and design and consent to get those, everything sorted for those projects. Whereas these ones, firstly they've been liaising with the local councils and various other stakeholders as well to try and make sure that this is stuff that can go ahead pretty quickly, and then it is the size that it shouldn't be such of an impediment in there in terms of things going quickly. But we have been disappointed about the government's effectiveness at achieving things with any sort of speed previously. So it's right to treat it with some element of caution, but fingers crossed that it might actually come through into something.
Be nice to see the full list at some point. But
it would be, but they seem to be, maybe it's a case of drip feeding it through the election build up to, win vote or, attract attention and win votes.
Which is a great segue and completely unintentional to this next question I want to answer from Daryl up in Northland around the election. Of course, we are sort of just under now 3 months out from the general election on 19 September, I think it is. Of course, for economists, 17 September is just as an important day with GDP numbers coming out. But Daryl's question is, what is our view over what that sort of political arena is going to do in terms of shaping the economic outcome? And I guess from our point of view, I don't know, we'll wait and see if any of the parties come out with any real policy around the economy, because there's a great amount of talk about plans. And look, I mean, everyone in this country could put out a plan saying we will do well for the economy and support growth. But at the moment, there's very little in the actual policy space to describe what's going to come out from an economic point of view. What we are starting to hear a lot of is there have been some relatively large announcements around infrastructure, not only from the government, but also from other opposition parties. Now, they're good, but a lot of them are going to take a while to get going. And if you're one of the 66,000 Kiwis sitting across the country without a job that has lost one in the last few months, you're more interested in how jobs are going to be supported over the next 1 to 2 years. And so again, I think in the last few weeks, politics has been firmly focused on people within the political arena, and look, that's part of the game, I guess. But from our point of view, we'll wait and see some hard and fast policy. We do have some information coming out tomorrow with the Infometrics 2020 Misery Index, which points towards what the numbers look like for the election, and so that's sort of a teaser, if you will, to read our newsletter tomorrow. I do want to turn on to some other bits and pieces that we're starting to see through. And there's a few questions coming through around councils and what we're likely to see across the country. Of course, councils across New Zealand gearing up for long-term plans to be finalised next year. And there's questions around sort of what that will mean moving forward. And so, Gareth, I'm going to sort of wrap the two questions we've got there into one, and we'll have a discussion Beattie, chip in when you feel the need. The first question's around how local government is going to go, or how those different areas are going to perform who might have had a 0% rates increase versus those who have still seen an increase in rates. And also the question moving forward of what's the best advice for councils around their infrastructure investment versus rates drivers over the next sort of, 2 to 3 election cycles, so sort of 5 to 6 years. And I mean, Gareth, I think, well, I'll see if I'm right. The feeling there would be that, those 0% rates increases, might be all right in the very short term, but if, as it seems to be across the country, there are still some sizable infrastructure needs, 0% rates increases only kick that can down the road, because you eventually either need to repair that those infrastructure assets, or you have to be content with being able to provide less to your people, essentially, isn't it?
Yeah, and look, we know there was major infrastructure issues at a local council level, not necessarily everywhere across the country, but across much of the country before COVID came along, whether it be in terms of the sort of wastewater networks, water networks and treatment and that sort of thing, which was going to need substantial investment going forward. And it was not clear anyway where that money was necessarily going to come from, given the cash position that many of the councils find themselves in, and the sort of debt that they've got as well. So for us, it's understandable that you've got, councils wanting to do well by their ratepayers and keep rates under control, keep a 0% rates increase there. But you're right, it's not sustainable over the medium term, given those cost pressures or sort of infrastructure investment pressures that are there. And indeed, the sort of implications around council spending, if you've got a 0% increase in your income and you're going to try and match that with no increase in your spending, it's sort of the opposite of what central government is doing at the moment, where they are actually actively trying to stimulate the economy and then pay the debt back later when, given that borrowing is relatively cheap. So in some senses, it kind of makes sense to try and keep the economy going, try and stimulate activity. But there is quite a divergence or a dichotomy there between what central government is doing and what's at least some local councils, the way that they are approaching the situation as well. So I think, look, for me, I would tend to advocate, if you can, borrowing, because money is cheap, and trying to get some of the work done. And when you're thinking about the long-term plans, don't go overboard with your debt and don't be ridiculous about the debt situation. But there are potentially opportunities there, and maybe it's a dialogue also that local government should be having with central government around trying to make sure that they are on the same page, and that the funding, where central government can provide assistance, that is also being taken advantage of.
Glad to see our mascots come back into shot there. No, I think you're absolutely right on that infrastructure. But the other point to make, of course, Gareth, is that that borrowing that's going on, essentially that spending needs to happen anyway. The question is, do you do it now and make sure you have some good assets for the future, or do you run your assets even lower and sort of wait and possibly have to pay even more to get things back up to scratch, and actually have more economic pain if if the case in Wellington, where you can't actually have an entire street open for a period. So I think you're absolutely right. And what I think we're going to see through this next wee while is that local government was hoping for a lot more government. We have seen some investments coming through in the water space, but not nearly enough. And so I think, again, there are concerns there over what's going to come through. I think our advice for local government and looking at those long-term plans, and again, happy to have discussions with people offline, is to make sure for that long-term plan that you do have a comprehensive set of projects and some good costings around them to understand how they all interlink, particularly around the likes of water assets and similar. Making sure there is that comprehensive plan means that when you do one set of investments, you can try and kill a few birds with one stone by doing them all together, rather than, say, ripping up the same bit of road 3 different times in 5 different years when you do it. And so there is going to need to be a bit more spending going on. But again, I think it highlights that the spending has to happen anyway. And so trying to get ahead of it and having a plan for where to go next, rather than just burying your head in the sand, actually becomes quite important, given the very low borrowing costs we're seeing at the minute. A question coming in around the tax policies, Gareth, and another fun one from a political angle around what does that mean going forward? And of course, in recent months, we've quite the discussion going on around, a wealth tax. Do we see changes in income tax? All of those different bits and pieces, or indeed do we see changes to government spending? So no contributions to the NZ Super Fund or similar. I mean, what's your view over the short and long around tax?
Yeah, I think over the next, say, 2 years, there'll be discussion, but I think you don't want to, one of the lessons we've seen from somewhere like Japan is that you don't want to go raising those taxes too prematurely, because you tend to stymie the economic recovery pretty sharply if you do end up doing that. So I think it's good to have discussions and to probably put some clear thought into it. It probably also depends on the makeup of Parliament following the upcoming election. Probably not too much doubt about which will be the sort of major governing party there in terms of Labour polling well ahead of National, although I would expect that gap to close a bit heading up to election. But it's more about who else is there. Is New Zealand First still there providing arguably something of a handbrake on some of the policies, whereas obviously the Greens, like you say, have been talking about a wealth tax, which I'm not sure that Labour would be on board with that. But yeah, looking forward from here, I think you do have to have a broader discussion about some of the stuff that the government put off the table following the tax working group's review. The broader economic environment has changed so much that we do actually need to be a bit grown up about whether a capital gains tax or a wealth tax is an appropriate response. I would expect potentially to see another income tax bracket brought in at a higher level, and beyond that, I don't know whether you do too much. I mean, the government's or at least Treasury's predictions are that, yeah, it takes some time to turn that debt position around and the fiscal deficit around, but it does come through over time. That's partly, of course, because your finance costs of your debt are relatively low, and the sort of debt shrinks a little bit over time. But I think there will have to be more active moves from the government. Probably, well, I say don't do it within 2 years, but then you run the risk of doing it just before an election, which is never going to be a popular thing to do either. So, an area definitely to watch the space, and certainly thinking about that make-up parties post-election.
But I think it's fair to say, sort of don't kneecap the recovery in the next 2 years, but possibly start talking about it so we can integrate it sooner rather than later when the recovery has moved through a bit further, I think. All right, last sort of question here, and I'll read it because it's it's a little bit lengthy, and so I'll get the entire thing out. Do we see benefit beyond the short-term employment hit for government spending on infrastructure and electricity system improvements to put New Zealand on a sound footing for the future? Now, of course, we noted the likes of the Onslow pumping station not really making sense at the moment from an economic point of view. But given that there are cheap borrowing costs, is it time that we actually do invest a bit more, particularly when it does have long-term benefits around the likes of climate change and those big problems that are still going to hit us in future years?
Yeah, I think in terms of some of those environmental outcomes, I'd agree that there is potential there. We've obviously talked quite a bit already about some of the basic network infrastructure that if you can borrow at the moment, then the funding is relatively cheap. So that makes sense as well. I guess my only question around ones that maybe don't make great economic sense, or don't seem to necessarily stack up right now. And it did amuse me, the government saying this, if they went ahead with this hydro scheme investment, that it would be the biggest investment in 50 years, or maybe they even used a longer time frame, I can't remember now. But then you look at many of the sort of think big investments that were done by Muldoon back in the 70s and 80s, not all of them, but many of them. And you go, well, actually, yeah, we sort of provided incentives, or the government spent a whole lot of money on the basis that we were sort of future-proofing the economy or insulating ourselves against shocks. And lo and behold, 40 or 50 years later, we see they're, under massive pressure in terms of closing down, whether it's Marsden Point up in Northland, whether it's Tiwai Point down in Southland. whether it's sort of energy, oil and gas and Methanex stuff and Taranaki, they haven't really survived the test of time. So you do have to be a little bit careful that while money's cheap, that you still don't necessarily get the payoffs over the medium term. Like I say, not all of them. You look at the Clyde Dam as being, it went well over cost and time in terms of how long it took to get going. But from an economic point and an electricity generation point of view, that one has had benefits. So not saying don't do them, but just because the money's cheap doesn't necessarily mean that you should just progress ahead with every idea that somebody has.
Totally. Awesome. Okay, I think we'll wrap up there. Thanks to everyone on the call. We've just ticked over about 5 minutes ago, in fact. So we will close things off there. Thanks so much, Gareth and Andrew, for coming along this time. Good to have a discussion around where our forecasts look like we're heading in the future. I think the main sort of feeling is that we've gone through this incredibly tough period of lockdown. We're now in this wait and see period, but once those supports are removed from the economy, we are likely to see much more sobering economic reality. So thanks everyone. Feel free to get in touch. We'll make sure that a copy of this is available in the Infometrics portal tomorrow morning. Keep safe and keep going along.
Cheers.